Before we dive in, a quick but critical disclaimer. I am not a financial advisor, and this video is for educational and entertainment purposes only. The information provided in this presentation does not constitute financial, investment, or legal advice. Trading cryptocurrencies involves significant risk, and you should always conduct your own thorough research and consult with a qualified professional before making any financial decisions. Your financial situation is unique, and any decisions you make are your sole responsibility. You've seen the ads. They're plastered all over the internet, sponsoring your favorite podcasts, popping up in your social media feeds. The message is always the same, and it's incredibly seductive. Trade crypto, zero commissions. Buy Bitcoin with zero fees. It sounds like a revolution, doesn't it? The financial system finally democratized. The little guy, the retail investor in their dorm room or on their lunch break, finally getting a fair shake against the towering giants of Wall Street with their exorbitant fees and secret handshakes. You download the app. It's sleek, it's easy. You link your bank account, and with a few taps you own a piece of the future. You buy some crypto, you sell some crypto, and you never see a line item for commission. Feels free. But have you ever had that nagging feeling? That little voice in the back of your head when you look at your final balance after a flurry of trades and you think to yourself, the math just doesn't quite add up. Something feels off. Where did that extra $10, $50, or even $100 go? What if I told you that zero fee is the single most profitable and most misunderstood marketing gimmick in modern finance? What if I told you that these platforms aren't just making money, they're making a fortune specifically because they don't charge you a direct fee? And they're doing it in ways that are so subtle, so deeply embedded in the mechanics of the market, that most people never even notice. They are masters of hiding costs in plain sight. They've turned your desire for a free lunch into their multi-billion-dollar banquet. In this video, we are going to rip the curtain back. We're not just going to tell you that free trading isn't really free. That's the easy part. We are going to arm you with the knowledge to see exactly how the magic trick is done. We're going to dissect the three silent killers of your crypto portfolio: the bid-ask spread, the controversial practice of payment for order flow, and the gauntlet of miscellaneous fees that bleed you dry. By the time you're done watching this, you will understand the fundamental business model of every single zero-fee platform out there. You will be able to look at two different exchanges and know instantly which one is actually cheaper, regardless of what their marketing says. This knowledge won't just make you a smarter crypto investor. It will make you a more skeptical, more intelligent consumer of any financial product. It could quite literally save you thousands or even tens of thousands of dollars over your investing lifetime. So let's start with the biggest, most common hidden fee of them all. The one that impacts every single trade you make, whether you're buying $1 million of Bitcoin or $50 of a new altcoin. It's called the bid-ask spread. And if you understand this one concept, you're already ahead of 90% of retail traders. The easiest way to think about the spread is to imagine a currency exchange booth at the airport. You walk up with $100. The sign says they buy euros for $1.10, and they sell euros for $1.20. You want to buy euros, so you have to pay the higher price, $1.20. 5 minutes later, you realize you don't need the euros, and you go back to the same booth to sell them. They won't give you $1.20 back. They will only buy them from you at their lower buy price of $1.10. That 10-cent difference between the price they buy at and the price they sell at is the spread. It's their profit margin, baked directly into the transaction. They didn't charge you a fee, but they absolutely made money. Now let's apply this to your zero-fee crypto app. These platforms are acting as that currency exchange booth, but on a massive digital scale. Let's say the true global market price for one Bitcoin right now is exactly $60,000. That's the price big institutions are trading it for. You open your app and hit the buy button. The price you are offered is not $60,000. It's $60,050. This is the ask price, the price the platform is asking you to pay. At that exact same millisecond, another user on the same app hits the sell button for their Bitcoin. The price they are offered is not $60,000 either. It's $59,950. This is the bid price, the price the platform is bidding to buy it from them. Do you see what just happened? The platform bought a Bitcoin from one user for $59,950 and sold it to another user for $60,050. The $100 difference between the bid and the ask price. That's the spread. The platform just pocketed $100 instantly, without charging anyone a commission. Now multiply that simple transaction by millions of users, trading billions of dollars worth of crypto every single day. That is the engine of the zero-fee economy. It's not a small leak in your financial boat. It's a massive hole below the waterline, and it's always there on every single trade. You might be thinking, $50 on a $60,000 trade? That's less than 0.1%. What's the big deal? And for a single long-term buy and hold investment, maybe it isn't a catastrophic cost. But the zero-fee model isn't designed for long-term investors. It's designed to encourage activity, to make you feel like you can trade in and out of positions, chasing small gains without being punished by fees. But you are being punished. Every single time you click buy or sell, you are paying that spread. If you buy a coin and it immediately goes up by 0.1%, you haven't made any money. You've just broken even on the spread you paid to get into the position. To make a profit, the asset has to outperform the spread on both ends of the trade, the one you paid to get in and the one you'll pay to get out. This is why so many new day traders get wiped out. They don't realize they're starting every single race 100 yards behind the starting line. They're not just fighting the market's volatility. They're fighting a guaranteed, hidden commission that is mathematically engineered to work against them. And the more obscure or less traded the crypto asset, the wider that spread becomes. For Bitcoin or Ethereum, it might be relatively tight. But for that hot new altcoin everyone is talking about, the platform knows there's less liquidity and more demand, so they can widen that spread dramatically. You might be paying a 1, 2, or even 5% hidden fee without even realizing it, because it's all just bundled into the price you see on the screen. It's the most brilliant and most deceptive business model because it aligns perfectly with human psychology. We are hardwired to avoid explicit pain like a fee, but we are terrible at noticing implicit costs like a slightly worse price. The spread is the bread and butter of these platforms. It's their primary, dependable source of revenue. But it's just the tip of the iceberg. It's the most transparent of the hidden costs. There is another, far more complex and controversial way these platforms make money from your trades. A system where your free trade order isn't just a transaction. It becomes a product. A piece of valuable data that is packaged and sold in milliseconds to powerful high-frequency trading firms who can use that information to get an edge on the market and on you. It's a practice quietly imported from the world of stock trading. And in the unregulated Wild West of crypto, it has found a fertile new ground. It's called payment for order flow. And it's where the zero-fee model transitions from being simply misleading to something much more troubling. And understanding how it works will fundamentally change the way you view your trading app and the market itself forever. To understand payment for order flow, or PFOF, let's forget about crypto for just 1 minute. Imagine you want to buy a very specific, rare type of apple. You walk into a giant, bustling farmer's market. This is the public exchange like the New York Stock Exchange or NASDAQ. There are hundreds of sellers and buyers, all shouting out prices. The best price you can see for your apple is $10. Now, instead of going into the market yourself, you use a free personal shopper service. Let's call it Applehood. You tell your shopper, "Go buy me that specific apple. I'm willing to pay up to $10. You expect him to go into the main market and fight for the best price for you. But he doesn't. Instead, he walks around the back of the market to a massive private warehouse. This warehouse is owned by a single colossal fruit distributor. This distributor has a deal with your shopper. He tells your shopper, "Hey, don't take your customer's order to the public market. Bring all your orders directly to me. For every order you bring, I'll pay you a small fee." Your shopper agrees. He gives your apple order to the warehouse. The warehouse owner looks at your order, sees you're willing to pay $10, and sells you the apple for $9.99. Your shopper comes back to you and says, "Great news! I got you a better price. I got it for a penny less than the best price in the market." You're happy. You saved a penny. Your shopper is happy. He got paid by the warehouse. The warehouse is happy. Why? Because they knew from their vast network of information that they could buy that same apple from a farmer on the other side of the market for $9.90. So by routing your order to them, they made a 9-cent profit. Your price improvement of 1 cent was just a tiny slice of their profit, a little kickback to keep you happy and using the free service. Now scale this up. It's not one apple, it's 100 million shares of Tesla. It's not one shopper. It's a brokerage app with 30 million users. And it's not one warehouse, it's a handful of Titan-level market-making firms, like Citadel Securities and Virtu Financial. This is payment for order flow. Your zero-fee brokerage isn't making money from you. You aren't the customer. You and your trade are the product being sold. The real customer is the market maker. These high-frequency trading firms pay brokerages hundreds of millions, even billions of dollars a year for the right to execute your trades. So why is your order so valuable? It comes down to something called the bid-ask spread. This is one of the most fundamental concepts in finance, and it's the invisible engine that powers this entire system. On any exchange for any asset, be it a stock, a crypto coin, or a barrel of oil, there are two prices at any given moment. The bid is the highest price a buyer is currently willing to pay. The ask is the lowest price a seller is currently willing to accept. The difference between these two numbers is the spread. Let's say Bitcoin's bid price is $60,000, and the ask price is $60,001. That $1 difference is the spread. A market maker's entire job is to live inside that spread. They are willing to simultaneously buy from sellers at the bid and sell to buyers at the ask. If they can buy one Bitcoin at $60,000 and immediately sell it to someone else for $60,001, they've made $1. That doesn't sound like much. But high-frequency trading firms do this millions of times a second, across thousands of different assets. Those tiny fractions of a cent add up to billions of dollars in profit. This is where your dumb money order comes in. That's the industry term, by the way. Retail traders are often called uninformed flow or dumb money, not as an insult, but because our trades are typically small, predictable, and not based on sophisticated institutional knowledge. We aren't a hedge fund trying to offload a billion-dollar position that could move the market. We're just a person buying a few $100s of Ethereum. To a market maker, this is a golden goose. A predictable stream of millions of small orders is far less risky to handle than one giant market-moving order from a big institution. So, they pay brokerages a premium to get exclusive access to this flow. They are essentially paying to get a first look at your trade, to be the one on the other side of it so they can capture that bid-ask spread. Now, the defenders of this system, the brokerages and the market makers themselves, will scream from the rooftops about price improvement. They will point to studies and say, "Look, we are saving retail investors money. When you place an order on our platform, we route it to a market maker who often gives you a price that's slightly better than the best price publicly available on the exchange." And on a technical level, they aren't lying. That penny you saved on the apple is real. You might place an order to buy a coin at $10, and the market maker executes it for $9.99. You save 0.2 of a cent. The brokerage will then flash a notification on your screen. Congratulations! We saved you money through price improvement. It's a powerful psychological trick. It makes you feel like the system is working for you. But here's the question they don't want you to ask. Is that tiny sliver of a penny the best price you could have gotten? Or is it just the minimum amount the market maker had to give you to make the transaction look good, while they still captured the lion's share of the profit from the spread? Think back to the apple. You got a 1-cent discount. The warehouse made a 9-cent profit. Who really won that trade? The warehouse captured 90% of the available profit on your transaction. This happens millions of times a day. The price improvement you receive is often just a fraction of the total profit being generated by your order. If your order had gone to the open public market, could competitive forces have pushed the price even lower, giving you a 5-cent discount instead of one? That's the multi-billion-dollar debate. And this isn't just a stock market problem. While the term PFOF is most associated with stocks, the exact same model exists in the crypto world, often in an even less regulated environment. Many zero-commission crypto apps are not exchanges. They are brokers. When you tap buy on Dogecoin, your order isn't going to a public order book. It's being routed, packaged, and sold to a massive third-party liquidity provider or market maker who pays for that flow. They execute your trade, profit from the spread, and give a cut back to the app. The free trade you just made was the fuel for someone else's profit engine. But the lost fraction of a penny isn't the most dangerous part of this story. Not even close. The real cost isn't measured in cents. It's measured in information. Because when these market makers buy your order flow, they are getting something far more valuable than a single trade. They are getting a live, real-time fire hose of data on what millions of retail investors are doing, thinking, and planning before anyone else in the market. They see the collective sentiment of the crowd before it even registers on the public exchange. They see the tidal wave of buy orders for a meme coin forming before it crests. They see the panic selling begin a few milliseconds before it triggers a landslide. They have a godlike view of the market, a crystal ball that shows them the immediate future. And this information asymmetry, this gap between what they know and what you know, creates a fundamentally tilted playing field. It allows them to not just react to the market, but to position themselves ahead of it, to profit from the very moves you and millions of others are about to make. So, the question becomes, what do they do with this incredible power? How is this fire hose of data being used? And what does it mean for your ability to actually succeed in these markets? Is it just about capturing the spread? Or is there something deeper, something more predatory happening behind the curtain of your simple, free trading app? To understand what's happening, we need to pull back the curtain and look at the real business model. It's a term you might have heard thrown around, but most people don't grasp its true, bone-chilling implications. Payment for order flow, PFOF. These 4 words are the secret engine that powers the entire free trading revolution. And once you understand it, you'll never look at that friendly, colorful app on your phone the same way again. Imagine you own a restaurant and you decide to offer every single meal for free. Lines are out the door. You're the most popular spot in town, but you're losing a fortune. How do you stay in business? Well, what if a massive global beverage corporation comes to you and says, "We'll pay you $1 million a month. In exchange, you send every single person who orders a drink to a special counter in the back, run by us. We'll handle their drink order. And you have to promise you won't send them to any other beverage company." You'd take that deal in a heartbeat. Now your restaurant is wildly profitable, and your customers still think they're getting a free lunch. That's payment for order flow. You are the customer ordering a meal. Your broker, the zero-fee app, is the restaurant. And that massive beverage corporation? That's a high-frequency trading firm, or HFT, a market maker. Think of giants like Citadel Securities or Virtu Financial. These are multi-billion-dollar behemoths with server farms located right next to the stock exchange's own servers, connected by fiber optic cables to shave microseconds off of transaction times. When you press buy on $1,000 of Bitcoin, your app doesn't just go out to the open market and find a seller for you. Oh no, that's not what happens at all. Instead, your broker takes your order, bundles it up with thousands of other little retail orders, and sells that bundle directly to the highest bidder, one of these HFT firms. The HFT firm pays your broker a fee, typically fractions of a penny per share or a percentage of the crypto trade's value, for the exclusive right to handle your order. That fee is the payment for order flow. That is their revenue. They aren't making money on fees from you. They're making money by selling you. Your order is the product. Now the critical question is, why? Why on earth would a sophisticated Wall Street titan pay a fortune for your tiny $100 crypto trade? The answer is information. In the market, information is more valuable than gold. By buying up all the order flow from retail apps, these HFT firms get a private, real-time look into what millions of average investors are doing. They see the tidal wave of buy and sell orders a fraction of a second before the rest of the market does. It's like playing a poker game where you're dealt a magic card that lets you see your opponent's hand for just 1 millisecond before you have to place your bet. In that millisecond, you see they have a weak hand, so you bet aggressively. Or you see they have a monster hand, so you fold. You might not win every single hand, but if you can play thousands of hands an hour with that tiny informational edge, you are mathematically guaranteed to walk away with all the chips. You can't lose. That's what HFT firms are doing. They see your buy order for Bitcoin coming down the pipe. In the milliseconds it takes to process, their algorithms can race ahead of your order, buy up Bitcoin on another exchange where it's a fraction of a cent cheaper, and then turn around and sell it to you to fill your order, pocketing that microscopic difference. It's called front-running, and while there are legal nuances, this is the basic principle. They do this millions of times a second across thousands of assets. Those fractions of a penny add up to billions of dollars in profit. Profit that is, in essence, extracted from the aggregate of retail traders like you. Now, the brokers and the HFT firms have a very clever defense for this. They'll tell you that PFOF is actually good for you. They'll say it provides you with price improvement. They'll claim that the market maker who bought your order often fills it at a slightly better price than the best available price on the public market. So if Bitcoin is trading at $30,000, they might fill your order at $29,999.98. They'll show you a little notification. Congratulations! We saved you 2 cents through price improvement. And on the surface, this sounds great. It's technically not a lie. You did get a slightly better price than the public quote. But it is a masterclass in misdirection. It's designed to make you ask the wrong question. The right question isn't, did I get a better price than the public quote? The right question is this the best possible price I could have gotten? And the answer to that is almost always a resounding no. The market maker is not your friend. They are a profit-seeking entity. They paid for your order so they could make money from it. They give you just enough price improvement to look good and to satisfy regulatory requirements, while they keep the vast majority of the potential profit for themselves. If there was a 10-cent per coin opportunity for profit on your trade, they'll give you 2 cents as price improvement and pocket the other 8 cents. You feel like you won, but they're the ones getting rich. It's a classic con. They hand you $1 with one hand to distract you from the $10 they're pulling from your pocket with the other. And in the world of crypto, this model is on steroids. The stock market, for all its flaws, is relatively centralized and regulated. Crypto markets are the Wild West. They are fragmented across dozens of exchanges around the world, each with slightly different prices at any given moment. The volatility is extreme. The spreads are far, far wider. This creates a paradise for high-frequency traders. The opportunities for arbitrage, for exploiting those tiny price differences between exchanges, are immense. So when a zero-fee crypto app sells your order to a market maker, they are feeding you to a much bigger shark in a much more dangerous ocean. The potential profit to be extracted from your crypto order is orders of magnitude larger than with a simple stock trade. This whole system is then wrapped in a psychologically manipulative package. The apps are designed to feel like games. You get digital confetti when you make a trade. Push notifications constantly prod you about market movements. The goal is to maximize your engagement, to make you trade more often. Because remember, every single time you tap that buy or sell button, you are generating a new, fresh order. A new product they can sell. Your wins, your losses, it doesn't matter to them. They get paid either way. They have successfully turned your financial journey into their recurring revenue stream. You think you're playing the crypto market, but the disturbing truth is, you are the market that is being played. So, we have the bid-ask spread, a visible but often ignored cost. And we have payment for order flow, a nearly invisible system that siphons billions from retail traders. But what if there's a third layer? What if the conflict of interest is even more direct, even more profound? What happens when the platform you're trading on isn't just a neutral intermediary selling your orders, but is, in fact, the one on the other side of your trade? What if, for them to win, you have to lose? Is your broker a bridge to the market? Or are they the final boss, secretly betting against you every step of the way? This model is known in the industry as a B-book brokerage. And it is the single most important concept you need to understand to protect yourself in the world of zero-fee trading. The answer to that question, is your broker betting against you, is in a shocking number of cases a resounding yes. They aren't just a bridge, they are the casino. And you just walked in the door. To grasp this, you need to know about the 2 fundamental ways a broker can handle your order. The first is the one we all imagine, the one they show in the commercials. This is the A-book. When you place a trade with an A-book broker, they act as a true intermediary. They take your order and immediately pass it through to the real market, to a liquidity provider and exchange, what's known as the interbank market. They are a conduit. Their goal is to match your buy order with the sell order out there in the vast ocean of the market. They make their money in a transparent way, either through a small fixed commission on your trade or through a tiny visible markup on the spread. In this model, the broker's interests are actually aligned with yours. They want you to trade as much as possible for as long as possible. A successful, high-volume trader is their best customer, because every trade generates a small, predictable fee for them. They win when you participate. They don't care if you win or lose a specific trade, as long as you keep coming back to the table. But then there's the B-book. When you place a trade with a B-book broker, your order never leaves their building. It never touches the real market. Instead of finding a seller for your buy order out in the world, the broker themselves becomes the seller. They take the other side of your bet. You want to buy Bitcoin at $50,000 because you think it's going up? Fine. The B-book broker sells it to you from their own inventory. You are not trading against the market anymore. You are trading directly against your broker. And this is where the economics get terrifyingly simple. If you win, if Bitcoin goes to $51,000 and you sell, the broker has to pay you that $1,000 profit out of their own pocket. Your win is their direct loss. But if you lose, if Bitcoin drops to $49,000 and you sell at a loss, or you get liquidated, your $1,000 loss is their direct, pure profit. They simply pocket the difference. Now, which model do you think is more profitable for the broker? The A-book, where they make a few dollars in commission, or the B-book, where they have the chance to take your entire account balance? It's not even a contest. The B-book is a potential gold mine, and the zero-fee structure is the perfect bait to lure you into it. They don't need to charge you a $5 commission when they're positioned to take your entire $5,000 deposit. The free part is just the cost of customer acquisition. You are not the customer, you are the product. More accurately, your losses are the product. At this point you might be thinking, wait a minute, that's a huge risk for the broker. What if I'm a trading genius? What if I win all the time? They'd go bankrupt. And you're right, that is the risk. But here's the cold, hard statistical truth that these platforms have built their empires on. Most retail traders lose. It's not an opinion, it's a widely documented fact. Depending on the market and the time frame, somewhere between 80 and 95% of retail traders lose money and eventually blow up their accounts. A B-book broker isn't making a risky bet. They are operating a casino. They know that over thousands of clients and millions of trades, the statistical edge is overwhelmingly in their favor. The house always wins. They don't need every single trader to lose. They just need the overwhelming majority to lose. And they do. But it gets even more sophisticated and frankly more sinister. Modern brokers don't just run an A-book or a B-book. They run a hybrid model. They profile you. From the moment you sign up, their algorithms are watching you, analyzing your every move, and deciding which book to put you in. Are you a new trader? Did you deposit a small amount, say under a few $1,000s? Do you tend to use high leverage? Do you trade on your phone based on news headlines? Do you place trades without a clear stop loss? Congratulations, you are the perfect B-book client. The algorithm flags you as a high-probability loser. Your trades are all internalized. The broker takes the other side of every single one, sits back, and waits for the statistical certainty of your failure to turn into their profit. But what if you're a shark? What if you deposit a large sum, use sophisticated strategies, manage your risk meticulously, and start making consistent, steady profits? The algorithm sees this too. It flags you as a toxic trader, toxic to their B-book, that is, betting against you is a losing proposition. So what do? They quietly move you over to the A-book. They stop trading against you and start passing your orders to the real market, happy to collect the small commission or spread. You're too dangerous to bet against, so they treat you like a traditional client. You might never even know you've been switched. You just think you're using a regular broker, while the person trading next to you is being systematically fleeced. This creates the ultimate conflict of interest, a moral hazard that infects every aspect of your trading experience. Think about it. If your broker profits directly from your losses, what incentive do they have to give you fair and fast execution? Let's talk about slippage. That's when you click buy at a certain price, but your order gets filled at a slightly worse price. On an A-book, this happens because the market is moving fast. On a B-book, the broker has a direct financial incentive to create that slippage. If they can fill your buy order just a few pips higher or your sell order a few pips lower, that fraction of a cent is pure profit for them, multiplied by millions of trades per day. It's a license to print money by skimming from their own clients. And what about those mysterious platform freezes during peak volatility? You're in a hugely profitable trade, the market is screaming in your direction, you go to click close, and nothing happens. The button is grayed out. The platform is lagging. You watch in horror as your profits evaporate and your trade turns into a loss. For an A-book broker, this is a disaster. They want you to close that trade so you can open a new one and generate more commission. For a B-book broker, well, that glitch might have just saved them a massive payout and turned it into a massive profit. Their incentive is not for the platform to work perfectly for you. It's for it to work perfectly for them. This leads us to the most controversial accusation leveled against these brokers: stop-loss hunting. A stop-loss is an order you place to automatically sell your position if it drops to a certain price, to limit your losses. Since a B-book broker holds all of their clients' orders internally, they have a perfect map of where everyone's pain point is. They can see a giant cluster of stop-loss orders sitting just below the current market price. Now, imagine the price gets very close to that level. The broker has a choice. They can let the market do its thing, or they can intervene. They can manipulate their own price feed, creating a sudden sharp wick downwards that is just long enough to trigger that huge cluster of stop-losses. This creates a cascade of forced selling. For the broker, who is on the other side of all those trades, it's like hitting the jackpot. They absorb all those losing positions in an instant. You'll look at the price chart on another, more reputable exchange and see that the price never even got that low. But on your zero-fee platform it did. And your money is gone. Is your broker a bridge to the market? Or are they a predator, actively engineering the conditions for you to fail? When their profits are directly tied to your losses, the entire relationship is poisoned. The zero-fee promise isn't a gift. It's a weapon. It's the camouflage that allows this predatory model to thrive by attracting the most vulnerable and uninformed participants. So now that we've pulled back the curtain on this deeply disturbing model, the most important question remains. How can you tell? How do you spot the red flags and differentiate a legitimate broker from a B-book casino that's just waiting to take your money? How do you protect yourself? It starts by learning to read the tea leaves. It's about knowing which little details, which seemingly insignificant quirks, are actually giant flashing neon red flags. These platforms are masters of disguise, but they're not perfect. They leave clues, and if you know what to look for, their entire business model unravels right before your eyes. The very first place you must look, the absolute non-negotiable starting point, is regulation. I know it's the least exciting word in the crypto space. It's boring, but in this context, it is your single greatest shield. Ask yourself, who is overseeing this company? Where are they registered? A legitimate financial institution, which is what a broker is, will be proud of its regulatory status. They'll display it prominently on their website's footer, on their About Us page. They want you to know they are held to a high standard. Now, not all regulation is created equal. There's a world of difference between a broker regulated by the SEC or CFTC in the United States, or the FCA in the UK, and a broker regulated in St. Vincent and the Grenadines or the Marshall Islands. These offshore jurisdictions are notorious for their light touch, or virtually non-existent, financial oversight. Getting a license there can be as simple as filling out a form and paying a small fee. It offers you, the customer, close to zero protection. If they run off with your money, there is no one to call. There is no authority that will force them to make you whole. So red flag number 1. Vague, non-existent, or offshore island regulation. If they can't prove they are accountable to a top-tier authority in a major economic region, you should assume they are accountable to no one but their own bottom line. Okay, let's say they have some semblance of regulation. The next clue is hidden in plain sight, every single time you make a trade. It's called the spread. The spread is simply the difference between the buying price, the ask, and the selling price, the bid, of an asset at any given moment. This is a normal part of every market. But for a B-book broker, the spread isn't just a market feature. It's a weapon. Here's how you check it. Open up their platform. Now, on a separate screen, open up a trusted, neutral price source. This could be a major, high-volume exchange like Coinbase or Binance, or a data aggregator like TradingView. Look at the price of Bitcoin on both screens at the exact same time. On the legitimate exchange, the spread might be a couple of dollars. The price to buy might be $50,002, and the price to sell might be $50,000. A $2 difference. But then you look over at the zero-fee platform. The price to sell might be $49,980, but the price to buy is $50,050. That's a $70 spread. What does that mean? It means the moment you buy, you are instantly down $70. You have to make up that $70 gap just to break even. They've built their fee directly into the price they offer you, and it's often far, far higher than any transparent commission would have been. They are selling you an asset for more than it's worth, and offering to buy it back from you for less than it's worth. That difference, that artificially inflated spread, goes directly into their pocket. It's their primary revenue stream, and it's coming straight out of yours. So red flag number 2. Unusually wide spreads compared to major exchanges. Always have a neutral price feed open for comparison. If their prices are consistently worse, you're not getting a free trade, you're getting a hidden and often expensive one. The third red flag is more subtle, but it's where they really twist the knife. It's the trifecta of poor execution. Slippage, requotes, and platform freezes. Let's start with slippage. Slippage is when the price you get is different from the price you clicked. A small amount of slippage is normal in very fast-moving markets. But on a B-book platform, it becomes a tool. Funny, isn't it, how slippage almost always seems to go against you? You place a buy order and the price slips up, filling you at a higher price. You place a sell order, and the price slips down, filling you at a lower price. When your loss is their direct gain, they have every incentive to build systems that ensure the slips go in their favor. Then there are requotes. You see a price you like, you hit the buy button and a little box pops up. Price has changed. Accept new price. And of course, the new price is worse for you. This happens over and over, especially when the market is making a big move that you're trying to catch. Feels like the platform is fighting you, and that's because it is. The most sinister of all, though, are the platform freezes. The market is crashing or it's skyrocketing. This is the moment you stand to make or lose the most money. You try to close your position to take profit or cut your losses, and the button doesn't work. The platform is lagging. The screen is frozen. You frantically click, but nothing happens. Then, just as the big move ends, everything magically starts working again. But it's too late. Your profitable trade is now a loss, or your small loss has become a catastrophic one. This isn't a technical glitch. It's a feature. They are intentionally preventing you from closing a trade because your loss is their guaranteed profit. So red flag number 3, consistent negative slippage, frequent requotes, and convenient freezes during high volatility. Your broker's platform should work best when you need it most, not worst. Next up is a psychological red flag: overly aggressive marketing and unbelievable bonuses. If a platform's advertising sounds more like a get-rich-quick scheme than a financial service, run. If they're flooding your social media with images of Lamborghinis, mansions, and people quitting their jobs after a week of trading, they aren't selling you a trading platform. They're selling you a lottery ticket. They are targeting your greed and your desperation, not your desire to learn a skill. And the bonuses: deposit $100, and we'll give you $200 in free trading credit. Sounds amazing, but it's a trap. Read the fine print. That free money can't be withdrawn, ever. And in order to withdraw your own money, you now have to trade an impossible volume, something like 50 or 100 times the bonus amount. They've locked your funds in. The bonus is just bait, designed to get you to deposit more than you should and trade more recklessly than you would. A legitimate broker might offer small, reasonable promotions, but they don't need to promise you the moon. Their product and reputation should speak for itself. So red flag number 4. Hype-filled get-rich-quick marketing and bonuses that seem too good to be true. They are. Finally, the ultimate test. The one that reveals their true colors beyond any doubt. The withdrawal process. This is the moment of truth. On a legitimate platform, withdrawing your money is simple. It might take a business day or two, but it's a straightforward process. On a B-Book casino, it's a nightmare. You put in a withdrawal request for a significant profit, and suddenly the problems begin. They need more verification documents even though you were verified to deposit. The documents you send are the wrong format. They're blurry. The process drags on for weeks. Your emails to customer support go unanswered, or you get generic, unhelpful replies. Sometimes they'll just straight up freeze your account, claiming suspicious activity. The suspicious activity being that you won and now you want your money. They will do everything in their power to make the process so frustrating, so infuriating, that you either give up or you trade the money away in anger. Because as long as that money is in your account, it's still in their pocket. So red flag number 5. A difficult, slow, or near impossible withdrawal process. If it's easy to put money in but hard to take it out, you're not a customer. You're a captive. Regulation, spreads, execution, marketing, and withdrawals. These are the 5 pillars of deception. By learning to spot them, you're no longer an easy mark. You're an informed consumer. You're pulling back the curtain and seeing the system for what it is. So you've learned to spot the predators. You know the dirty tricks of the B-Book model. But what's the alternative? If this is the wrong way, what does the right way look like? How do legitimate brokers, the ones that actually want you to succeed, make their money? What is the model that aligns their interests with yours? The answer lies in a fundamentally different business structure called the A-Book model. If a B-Book broker is a casino taking bets against its patrons, an A-Book broker is a true agent, a conduit to the actual market. They aren't your counterparty. They're your facilitator. When you place a trade with an A-Book broker, they don't just note it down in their own little black book. Instead, they immediately pass your order on to a larger network of liquidity providers. These can be major banks, investment funds, or even larger exchanges, the big fish in the financial ocean. The A-Book broker's job is simply to find the best available price for your order from these providers and execute it on your behalf. They are a bridge, not a bucket shop. So, if they aren't pocketing your losses, how do they keep the lights on? They do it in 2 very transparent, very traditional ways: commissions and spreads. A commission is the most straightforward fee you can imagine. You buy 1 Bitcoin, they charge you a small fixed fee, say $10. You sell it, they charge another $10. It's a simple upfront transaction fee for the service they provide, the service of connecting you to the real market. The other method, and the more common one in the crypto and forex world, is the spread. The spread is simply the tiny difference between the buying price, the ask, and the selling price, the bid, of an asset at any given moment. Let's say the real market price for Ethereum is a bid of $3,000, and an ask of $3,000.01. That 1 cent difference is the raw market spread. An ebook broker will take that raw spread and widen it ever so slightly. They might show you a bid price of $2,999.99 and an ask price of $3,000.02. Now the spread is 3 cents. When you buy from them, they buy from the real market and pocket that extra 2 cents. It's their fee for facilitating the trade. It's a volume game. They make a tiny fraction of a percent on millions of trades. And right there, in that simple mechanism, is the most important difference in the entire financial world: the alignment of interests. Think about it. How does an ebook broker make more money? They need you to trade more. They need you to place more orders. They profit from your activity, your volume. And what kind of trader is active for a long time? A successful one. Or at the very least, a trader who isn't losing their entire account in a week. Their entire business model is built on your longevity. They are financially incentivized to see you succeed. They want you to manage your risk, to learn to grow your account, and to keep trading with them for years. This is why you'll often see these types of brokers offering powerful trading tools, deep educational resources, and webinars on risk management. They're not doing it out of the goodness of their hearts. They're doing it because a smart, disciplined trader is a long-term, profitable customer. Your success is quite literally their success. Their revenue is tied to your participation, not your destruction. The ebook broker, on the other hand, profits from your failure. They want you to make emotional, oversized, high-leverage bets. They want you to ape in on a meme coin with your life savings because they know the statistical outcome. The faster you lose your money, the faster it becomes their revenue. It is a fundamentally adversarial relationship. You are not their client. You are their target. Let's use a clearer analogy. The ebook broker is the house in a Las Vegas casino. They set the odds, they control the game, and their entire architectural and psychological setup is designed to separate you from your money. They might give you a free drink, a deposit bonus, but they know that over time the house always wins. The ebook broker is more like a professional real estate agent. The agent makes a commission when you buy or sell a house. They don't care if the price of the house goes up or down after you buy it. Their profit is secured by the transaction itself. A good real estate agent wants to build a long-term relationship. They want you to be so happy with your purchase that you come back to them in 10 years when you want to sell it and buy a bigger one. They want you to recommend them to your friends. They succeed by facilitating successful transactions and building trust, not by hoping your new house gets foreclosed on. But it gets even murkier. Because in the real world, very few brokers are 100% pure A-book or 100% pure B-book. Many, if not most, operate on what's called a hybrid model. This is where it gets truly insidious. A hybrid broker runs sophisticated software that analyzes every single one of its clients and their trading habits. They profile you. Are you new? Do you use high leverage? Do you trade without stop losses? Do you chase volatile assets? If you check these boxes, if you fit the profile of a statistically likely loser, they put you in their B-book. They will internalize all your trades, knowing full well that they'll be collecting your losses as their profit. But what if you're a disciplined, experienced, and consistently profitable trader? What if you're a shark? The broker's algorithm will spot you too, and there is no way they are going to take the other side of your trades. They know you'll clean them out. So, for you, they switch to the A-book model. They'll dutifully pass all your orders to the external market, happily collecting their small commission or spread markup, content to make a safe, steady profit from your high trading volume. They become your agent, your facilitator, because being your adversary would be financial suicide for them. This is the broker's dream. They get the best of both worlds. They profit from the failure of the 90% and they profit from the activity of the 10%. But for you, the customer, it's a nightmare of uncertainty. You have no idea which book you're in. Is the platform your partner or your predator today? The answer can change from one trade to the next without you ever knowing. So how can you spot the potential red flags of a broker that's running a B-book or a predatory hybrid model against you? The signs are often subtle, but they're there. The most common is poor trade execution, especially during times of high volatility. Have you ever tried to close a profitable trade right as the market is screaming in your favor, only to have the platform freeze or your click not register? Have you ever placed an order at a specific price, only to get a requote a second later at a much worse price? This is called slippage. While a small amount of slippage is normal in fast-moving markets, consistent, one-sided slippage that always works against you, filling your orders at worse prices but never better, is a massive red flag. It often means the broker is manually intervening, delaying your execution to protect their own B-book from your winning trade. Another sign is the marketing. A-book brokers tend to advertise their technology, their execution speed, their tight spreads, and their regulatory compliance. B-book brokers often lure customers with flashy, unrealistic promises, huge deposit bonuses, risk-free trades, and aggressive promotion of insane leverage, like 500 to 1 or 1,000 on. They do this because leverage is the fastest way for an inexperienced trader to blow up an account. A 1,000 to 1 leverage means a tiny 0.1% market move against you wipes out your entire position. They offer these tools not to help you, but to accelerate your path to ruin, and to their bottom line. So we have the predatory casino of the B-book, the aligned partnership of the A-book, and the two-faced nature of the hybrid model. This brings us back to our central question. Where do the zero-fee and zero-commission platforms fit into this picture? On the surface, it seems impossible for them to be an A-book broker. A-book brokers have clear costs, commissions, and spreads that they pass on to the customer. So if these popular mainstream apps aren't charging you a fee, and they swear they aren't a B-book casino betting against you, where is the money coming from? How are they paying for those Super Bowl ads and celebrity endorsements? The answer lies in a third path, a controversial practice that exists in a gray area of the market, known as payment for order flow. Payment for order flow. It sounds complicated, but the concept is surprisingly simple. Imagine you order a pizza from a free delivery app. You don't pay a delivery fee, which sounds great. But what you don't see is that the app isn't just a delivery service. It's also selling your order information. A massive industrial-sized kitchen, let's call it Mega Pizza Corp, pays the app for your order. Why? Because Mega Pizza Corp knows exactly what ingredients to use, how to make the pizza for the lowest possible cost, and can still sell it to you at the menu price, guaranteeing themselves a profit. The delivery app gets paid, Mega Pizza Corp makes a profit, and you get your pizza delivered for free. But was it truly the best pizza you could have gotten for that price? Or did the app just send your order to the kitchen that paid them the most? That, in a nutshell, is payment for order flow, or PFOF. When you hit buy on a share of stock or a crypto coin on a zero-fee platform, you assume your order zips straight to a public exchange like the New York Stock Exchange, or a major crypto exchange like Coinbase or Kraken. That's how it used to work. But with PFOF, that's not what happens at all. Your broker, the free app on your phone, doesn't send your order to the open market. Instead, it bundles your order up with thousands of others and sells that bundle, that order flow, to a massive third-party firm. These firms are financial titans, high-frequency trading giants, and market makers like Citadel Securities or Virtu Financial. These companies pay your broker billions of dollars a year for the privilege of handling your trades. So the free trading isn't free for everyone. It's paid for by these market makers, who are buying your trades from your broker. This raises the immediate multi-billion-dollar question: why? Why would these Wall Street behemoths pay so much money just to execute your $100 Bitcoin purchase? The answer is the lifeblood of all markets: the bid-ask spread. For any asset, there are two prices at any given moment: the bid price, which is the highest price a buyer is willing to pay, and the ask price, which is the lowest price a seller is willing to accept. The ask is always slightly higher than the bid. The tiny gap between them is the spread. Let's say the bid for Ethereum is $2,999.95, and the ask is $3,000. That 5-cent difference is the spread. Market makers live inside that spread. Their entire business model is to buy at the bid and sell at the ask, capturing that tiny difference as pure profit. They do this millions, if not billions, of times a day. And this is where you come in. To these giant firms, your order is special. They don't see you as a savvy investor. They see you as what the industry calls uninformed order flow. That sounds insulting, but it's a technical term. It means you're a retail investor. You're not a hedge fund with a supercomputer trying to predict the market's next move in the next microsecond. You're just a person buying some crypto because you think it'll go up over time. Your trades are predictable, small, and carry almost zero risk for the market maker to execute. They know you're not about to crash the market. You are, in their eyes, the perfect customer. By buying up all this low-risk retail order flow, market makers can reliably profit from the bid-ask spread on a massive scale without worrying about a sophisticated trader outsmarting them. They are paying for a sure thing. Now, the defenders of this system, including the platforms themselves, will tell you this is a win-win-win situation. They argue it's the greatest innovation in modern finance. First, you win. You get to trade with zero commissions. On top of that, they claim you often get price improvement. The market maker, they say, will often execute your trade at a price slightly better than the best available price on the public exchanges. So if the best ask price for a coin is $10.01, they might fill your buy order at an even $10, saving you a penny. Second, your broker wins. They get paid by the market maker, which allows them to run their entire business, build a fancy app, and run those Super Bowl ads, all without charging you a dime in commissions. And third, the market maker wins. They get a steady stream of profitable orders and make their money on the spread. Everyone is happy, the system is more efficient, and trading is democratized for the masses. It sounds like a perfect, frictionless utopia. But if you peel back just one layer of this story, the entire structure starts to look a lot less like a win-win-win and a lot more like a fundamental, deeply troubling conflict of interest. Your broker has a legal and ethical obligation known as duty of best execution. This means they are required to get you the best possible price for your trade. But with payment for order flow, your broker also has a powerful financial incentive to send your order not to the market maker who will give you the best price, but to the market maker who will pay them the most. These two goals are often in direct opposition. Is your broker truly fighting to save you an extra fraction of a cent per share? Or are they routing your trade to the firm that helps them make payroll and boost their own stock price? The incentive structure is, at its core, compromised. And what about that price improvement? Is it a genuine benefit? Or is it a marketing gimmick? The reality is that the market maker, by internalizing your order, is capturing the entire bid-ask spread. Let's say that spread is 4 cents. They might give you 1 cent back as price improvement and pocket the other 3 cents as profit. You feel good because you saved a penny, but the market maker just made 3 cents on a transaction that, on a public exchange, might have been executed at an even better price for you. You're not getting the best price. You're just getting a small rebate on the profit the market maker is making from you. That free trade isn't free. The cost is simply hidden inside a slightly worse execution price. A cost that is imperceptible on a single trade, but adds up to billions of dollars when scaled across the entire market. This leads to an even bigger, more systemic problem. By routing millions of retail trades away from public exchanges, PFOF creates what are essentially private markets, sometimes called dark pools. A huge portion of all trading activity now happens off-exchange, hidden from public view. This fragments the market and can make the prices you see on the public tickers less reliable, because they don't reflect the true supply and demand from a massive segment of traders. It makes the entire market less transparent. The regulators know this. In 2020, the SEC fined Robinhood $65 million for, in their words, failing to satisfy its duty to seek the best reasonably available terms for customer orders. The SEC found that Robinhood's customers had lost out on millions of dollars by receiving inferior prices, all while the company touted its commission-free model. This isn't a theoretical problem. It's a documented reality. And this brings us directly back to crypto. The world of crypto is famously the Wild West, with far less regulation than the traditional stock market. If these conflicts of interest and hidden costs are a massive issue in the highly regulated equities market, imagine the potential in the crypto space. A zero-fee crypto platform can engage in the exact same practices, selling your order flow to large, specialized crypto market makers. But here, they can do it with even less oversight and transparency. The duty of best execution is a vaguer concept, and the public data on pricing across different venues is far more chaotic. You could be getting a significantly worse price on your crypto purchase, funding the platform's entire operation, and you would have almost no way of ever knowing it. So, payment for order flow turns your free trade into a product that's sold to the highest bidder. In this model, you're not the customer, you're the merchandise. But this is just one piece of the puzzle, one major revenue stream. Even on platforms that claim they don't use PFOF, and on centralized exchanges themselves, there's another more fundamental way they make money on every single free transaction you make. It's a cost that's baked directly into the price of the crypto you buy and sell, a hidden tax that most traders never even see. It's called the spread, and how they manipulate it is the oldest and perhaps most profitable trick in the book. To understand the spread, just think about the last time you exchanged currency at an airport. You see two prices on the board for euros, a buy price and a sell price. Let's say they'll buy your dollars for 90 euro cents, but they'll sell you euros for 95 cents. That 5-cent difference? That's their profit. That's the spread. It's the price of convenience. Now take that simple concept, inject it with algorithmic trading, market volatility, and billions of dollars, and you have the business model of nearly every zero-fee crypto platform. In the world of finance, this is called the bid-ask spread. The bid price is the highest price a buyer, in this case the platform, is willing to pay for an asset. It's the price you get when you hit the sell button. The ask price is the lowest price a seller, again the platform, is willing to accept. It's the price you pay when you hit buy. The spread is simply the gap between those two numbers. On a professional exchange, this gap is created by the natural supply and demand of thousands of buyers and sellers competing in an open market. The spread is often razor thin, a tiny fraction of a percent, because competition forces efficiency. But on a zero-fee app, you're not trading in that open market. You're often trading directly with the platform itself, or with a designated market maker they partner with. They are the house. They set both the bid and the ask price. And because there's no direct fee, their only way to make money on your trade is to make that spread wider. Artificially wider. Let's put some real numbers to this. Imagine the true global market price of one Ethereum is exactly $3,000. On a professional exchange like Kraken or Coinbase Pro, the bid price might be $2,999.50, and the ask price might be $3,000.50. The spread is just $1. A tiny competitive cost of doing business. Now you open your sleek, zero-fee app. The app also sees the true market price is $3,000. But it doesn't show you that price. Instead, it shows you an ask price, your buy price, of $3,025. And it shows you a bid price, your sell price, of $2,975. The spread here isn't $1. It's $50. That $50 difference is their revenue. It's a 1.66% fee hidden in plain sight. You didn't see a line item that said commission, but you absolutely paid a fee. You just paid it by getting a worse price on your purchase. You bought high, and if you were to sell immediately, you'd be forced to sell low, instantly losing $50 to the platform. They are banking on the fact that most retail users are looking at the big, flashy chart, not the tiny bid-ask numbers. They're focused on whether Ethereum is going to 4,000, not whether they're paying 3,000 or 3,025. But those small differences, compounded over millions of users and billions of dollars in volume, are how these companies become financial juggernauts. It's a volume game. A few dollars from you, a few from the next person, a billion times over. This gets even more predatory when the market gets chaotic. Volatility is their best friend. When the market is pumping and you have a severe case of FOMO, or when it's dumping and you're panic selling, what's the one thing you're not doing? You're not carefully comparison shopping for the best price. You just want in or you just want out right now. The platforms know this. They have teams of behavioral psychologists who understand your impulses better than you do. And so, in these moments of high volatility, they dramatically widen the spread. That $50 spread on Ethereum might suddenly become $150. Why? Because they can. They know you're not going to stop your panic sell to log into another exchange and check if you can get a better price. You're going to smash that sell button. In that moment, they're not just a platform, they're a toll booth on the highway out of a burning city, and they can charge whatever they want. They are directly profiting from your fear and your greed. This isn't a conspiracy theory. It's just the raw, unadulterated mechanics of their business model. But the hidden costs don't stop at the spread. There's another, more subtle factor at play called slippage. Slippage is the difference between the price you see on the screen when you click buy and the price your order actually gets executed at. Crypto markets move in milliseconds. In the time it takes for your order to travel from your phone, across the internet, to the platform servers, the price can change. If the price moves against you in that fraction of a second, say it goes up right before your buy order is filled, you end up paying a slightly higher price than you expected. That's negative slippage. Now, in a fair market, slippage should be random. Sometimes it should go in your favor, sometimes against you. But on platforms where the house is also your trading partner, there's a built-in incentive to make sure slippage works in their favor more often than not. They can control the execution queue. They can see the incoming order flow. It's not a stretch to imagine a system designed to fill your order at the most advantageous price for the platform, not for you, within a reasonable margin. A few cents of negative slippage here, a dollar there. It's the digital equivalent of a butcher putting his thumb on the scale. It's almost impossible for you to prove, but over millions of trades, it adds up to a fortune. This all ties into a core financial principle called best execution. Regulators require traditional stockbrokers to provide their clients with the best possible execution for their orders. This doesn't just mean speed, it means seeking out the best price. If your broker could have gotten you a stock for $100.01 on one exchange but instead filled your order for $100.05 on another, they've failed their duty. Now ask yourself, are these zero-fee crypto platforms, with their artificially wide spreads, truly giving you best execution? The answer is an unequivocal no. The very foundation of their business model is built on giving you a worse price than is available on the open market and pocketing the difference. You are paying for the convenience of the simple user interface, not with a transparent fee but with poor trade execution. Let's quantify this. Imagine you decide to invest $1,000 into Bitcoin every month for a year. That's a total of $12,000. Let's say you use a zero-fee platform that has an average spread of 1.5%. Over the course of the year, that hidden 1.5% fee has cost you $180. Now, let's say your friend does the exact same thing, but uses a professional-style exchange that charges a transparent 0.4% taker fee. Their total cost for the year? $48. You paid nearly 4 times more for the illusion of free. The free platform was actually the most expensive option. This isn't just about a few dollars. It's about a fundamental deception in how these platforms market themselves. They've brilliantly reframed the conversation from who is the cheapest to who is free. By doing so, they've managed to charge some of the highest effective fees in the industry, while convincing an entire generation of investors that they're getting a great deal. The spread isn't just a cost. It's a psychological masterpiece, a fee so perfectly integrated into the product that you don't even feel it leaving your pocket. So while they're taking a slice of every single trade you make, profiting from every market swing and every emotional decision, that's just the beginning. That's only their first, most obvious revenue stream. The real money, the truly mind-boggling profits, are made in what happens after you click buy, in what they do with your crypto while you think it's just sitting safely in your account. This is the shadow banking system of the 21st century, and your crypto is the fuel. Let's start with the big one, lending. When you buy one Bitcoin and leave it on a zero-fee platform, you see one BTC in your account. You assume it's sitting in a digital vault with your name on it like gold bars at Fort Knox. That is a comforting but completely false assumption. In reality, the platform takes your Bitcoin, pools it with Bitcoin from thousands of other users, and then lends it out to the highest bidder. Who are these bidders? They're not small-time traders. They are massive hedge funds, institutional trading desks, and other large financial players. And why do they want to borrow your Bitcoin so badly? The primary reason is to short sell it. Think about it. A hedge fund believes the price of Bitcoin is about to drop. To profit from this, they need to borrow Bitcoin they don't own. They go to your free platform and say, hey, can we borrow 1,000 Bitcoin? We'll pay you a hefty interest rate. The platform says, absolutely, and hands over a chunk of its users' pooled assets, including yours. The hedge fund immediately sells that 1,000 Bitcoin on the open market for, let's say, $50 million. Now they wait. If their prediction is right and the price of Bitcoin drops by 10%, they can buy back that same 1,000 Bitcoin for only $45 million. They then return the 1,000 Bitcoin to the lending platform, pay a small interest fee, and walk away with nearly $5 million in pure profit. Where did your free platform make its money? They charge that hedge fund a significant interest rate for the loan, an annual percentage rate that can be anywhere from 3% to over 20% during times of high market volatility. And how much of that interest did you, the actual owner of the Bitcoin, receive? Zero. Nothing. You took on all the underlying risk, and the platform pocketed 100% of the profit. Your assets were used in a high-stakes Wall Street-style trade, and you were never even told it was happening. Now multiply this by millions of users and billions of dollars in assets. The platform isn't just a simple app. It's a colossal lending desk, generating hundreds of millions of dollars a year by renting out your property. But maybe you're thinking, okay, so what? They use my Bitcoin, but I get it back. What's the harm? This is where we have to talk about the single most important concept in crypto, counterparty risk. When the platform lends your crypto to that hedge fund, they are trusting that the hedge fund will be able to return it. But what if the hedge fund is wrong? What if they short Bitcoin and the price skyrockets instead? Their trade goes disastrously wrong, they lose billions of dollars, and they declare bankruptcy. They can't pay back the 1,000 Bitcoin they borrowed. Suddenly, the free platform has a $50 million hole in its balance sheet. The Bitcoin they owe you and thousands of other users is gone. Vanished. This isn't a theoretical risk. We have seen this exact scenario play out, toppling some of the biggest names in the industry. It creates a domino effect of collapse, and it all starts with this practice of lending out customer assets. And this is where the most terrifying part comes in. It's buried deep in the 50-page terms of service agreement that you scrolled through and clicked, "I agree" on. In that fine print, there is almost always a clause that fundamentally changes your relationship with your own money. The legal language is dense, but what it boils down to is this. When you deposit your crypto onto their platform, you are often transferring the legal title of those assets to the company. You no longer own your Bitcoin. What you own is an IOU from the platform. You have become an unsecured creditor. Think about that. You are not a customer storing your property. You are a lender who has given an unsecured loan to a company, and your account balance is just their promise to pay you back. This single legal trick is what gives them the right to do whatever they want with your crypto, lend it, trade with it, use it as collateral. And it's what leaves you completely exposed if they go bankrupt. If the platform collapses, you don't just log in and withdraw your funds. You have to get in line with every other person and company they owe money to, and wait for the bankruptcy courts to maybe give you back a few cents on the dollar years down the line. That is the hidden price of free. You trade ownership and security for convenience. But lending isn't the only game they play. There's another, slightly less risky but still incredibly profitable, revenue stream called staking as a service. Many cryptocurrencies like Ethereum operate on a system called proof of stake. In simple terms, you can stake your coins, which means locking them up to help secure and validate the network. In return for performing this service, the network pays out rewards, kind of like earning interest. Now, staking on your own can be technically complex. You need to run special software, maintain a server, and have a minimum amount of crypto, which for Ethereum is 32 ETH, well over $50,000. Most people can't do that. So the free platforms offer a simple solution. Stake your ETH with us. Just one click. When you click that button, your ETH is pooled with everyone else's. The platform takes this giant pool, runs all the technical infrastructure themselves, and collects the staking rewards from the network. Let's say the network is paying out a 4% annual reward. The platform collects that full 4%. Then they turn around and pay you, the user, a lower rate, say 3.5%. That 0.5% difference is their commission. It's their fee. They are a middleman, and they are taking a cut for providing the service. Again, 0.5% doesn't sound like much, but when you're managing billions of dollars in staked assets for millions of users, it becomes an enormous, consistent, and relatively low-risk revenue stream. They're skimming profit off an activity that is fundamentally meant to reward the network's users, not a centralized intermediary. So when you see zero fees, you have to understand you're just not seeing the bill. The cost is paid through the spread on your trades, through the immense profits they make lending out your assets while you take the risk, and through the commission they skim off your staking rewards. You are not the customer of a free service. You are the resource. Your capital is the product that they are selling to Wall Street, and the risk of it all collapsing lands squarely on your shoulders. They've built financial empires on these hidden mechanics, all while marketing themselves as a simple free tool for the everyday person. But we've still only scratched the surface. There is one more deeply controversial way these platforms can profit from you. It happens in the milliseconds after you hit the buy button, and it involves selling something far more valuable than your crypto, your trading intentions. And it opens the door for the market to potentially move against you before your order is even filled. This practice is known as payment for order flow, or PFOF. And while it was made famous in the stock market, its principles are alive and well in the wild, unregulated world of crypto. Here's how it works in its simplest form. When you place that free trade, your broker doesn't just send it to the open market to find the best price. Instead, they sell your order, your intention to buy or sell, to a massive third-party trading firm, often a high-frequency trading firm or a large market maker. These firms pay your broker billions of dollars a year for the right to see and execute your trades. Why would they pay for your little $100 Bitcoin purchase? Because they are buying information. They get a sneak peek at what millions of retail investors are about to do milliseconds before anyone else. This gives them a colossal advantage. They can use this information to trade ahead of the market, a practice often called front-running. They see your buy order coming, so they can snap up the asset at the current price and then sell it to you a fraction of a second later for a fraction of a cent more. You might be thinking, a fraction of a cent? Who cares? Well, they care. Because when you multiply that fraction of a cent by millions upon millions of trades every single day, it adds up to a multi-billion-dollar empire. And where does that money come from? It comes directly from you in the form of a slightly worse price on your trade. It's the ultimate hidden fee. You didn't get the best possible price in the market at that exact moment. You got the price the high-frequency firm was willing to give you. The difference is their profit and it's your cost. It is a fee, just one that never shows up on a statement. In the crypto world, this can be even more direct. Many zero-fee platforms aren't just brokers. They act as the market maker themselves. This is called internalization. When you hit buy, you aren't buying from another person on an open exchange. You are buying directly from the platform itself. And when you sell, you are selling to them. This creates a fundamental conflict of interest. Their goal is to maximize their profit on every single trade. And how do they do that? By widening the spread. By giving you a slightly worse price than the true market rate. They are, quite literally, trading against their own customers. So let's put this all together. The promise of zero-fee crypto trading is one of the most brilliant and deceptive marketing ploys of the modern financial era. It preys on our fundamental desire to get something for nothing. But as we've uncovered, it's a house of mirrors. The cost is always there, just cleverly hidden in plain sight. First, you have the spread. This is the biggest and most consistent hidden fee. The difference between the price you can buy at and the price you can sell at. On zero-fee platforms, this spread is often significantly wider than on professional exchanges. It's a built-in tax on every single transaction you make, both buying and selling. Second, you have slippage, the silent killer of profits, especially in the volatile crypto market. You see one price, you click the button, but by the time your order is actually filled, the price has moved. And on these platforms, it often seems to move against you. That small difference is another cost siphoned from your investment. Third, you have the explicit fees they hope you don't look for until it's too late. The exorbitant withdrawal fees, the fixed network fees, the ACH transfer fees. They make it free to put your money in, but they make damn sure you pay to take it out. And finally, the most invisible and complex cost of all, the structure of the market itself. Through payment for order flow or direct internalization, these platforms are selling your trade or trading against you. You may not be getting the best execution price, and that tiny difference, that fraction of a percent, is the fee that funds their entire operation. So what's the takeaway here? Should you run for the hills and delete every zero-fee app from your phone? Not necessarily. The answer is more nuanced. For someone just starting out, buying maybe $50 of Ethereum once a month, the sheer convenience and simplicity of these platforms might be worth the hidden costs. The few cents you lose in the spread might actually be less than the flat $5 trading commission you might pay elsewhere. For the casual dabbler, it can be a gateway. But, and this is a very important but, for anyone who is serious about investing in cryptocurrency, anyone trading with hundreds or thousands or tens of thousands of dollars, these hidden fees are not just a nuisance. They are a catastrophic drain on your potential returns. A 0.5% spread on a $10,000 trade is $50. Gone. Instantly. On a professional exchange, a typical trading fee for that same trade might be $10. That's a $40 difference on a single trade. Now imagine making dozens of trades a year. We're talking about thousands of dollars of your money, your profits, being evaporated into the platform's revenue stream. The goal of this entire breakdown was not to scare you. It was to arm you, to give you the knowledge to look past the flashy marketing and understand the real mechanics of the systems you're using. The most important lesson in all of finance is this: you are always paying. Always. The only thing that changes is how you pay and how much you pay. So from now on, be a skeptic. When a platform screams, zero fees, your first question should be, okay, so how do you make money? Read their fee schedule. Look for withdrawal fees. And most importantly, do your own comparison. Don't just take my word for it. The next time you want to buy a crypto, pull up your zero-fee app and a real-time price chart from a major exchange like Kraken or Binance at the exact same time. See the price they quote you. Calculate the spread. See how much crypto you actually get for your $100. The numbers won't lie. That difference, that gap between what you could have paid and what you did pay, that is the real cost of free. In the world of finance, and especially in the high-stakes, low-regulation arena of crypto, there's a timeless saying: if you're not paying for the product, you are the product. Your trade, your data, your market intentions, that is the commodity being bought and sold behind the curtain. The concept of a free lunch has always been a myth. But now, finally, you know exactly where to look for the price tag.